Hi, and welcome to Lever Brothers tutorial on bullish flags. Bullish flags are small continuation patterns that represent a brief pause within an existing uptrend. They appear flat or trade with a slight downward slant and typically occur in the middle of a large rally or immediately after a stock has broken out of a basing period. The slight short-term counter move opposite the trend is very healthy as it functions to scare off weak and emotional long positions that would otherwise slow the upside movement. These longs would methodically sell the stock as it continued up. But instead, as the stock slowly drifts down, these weak stockholders sell their positions, and once enough have sold, the overhead resistance in essence is cleared and the stock can continue up. Breakouts to the upside should be accompanied by a significant increase in volume and a close above the high of the pattern. Proper management techniques become more important if these are not accomplished. For starters, the rally into the pattern can be used to establish an expected target, but again, this is just for starters and should not be relied on heavily. Some traders will measure the move to the far side of the pattern and project it up from the breakout level as shown here. Others will measure to the midpoint. There is no right or wrong answer. This isn't an exact science. Targets are meant to give you a frame of reference to work from. They are not set in stone. The extent of an advance will often depend on the overall market. A strong market will greatly help in achieving an ambitious price target, but in a weak market, a trader should be happy with a moderate gain. Let's check out a couple of examples. Here's D.R. Horton. The stock was steadily trending up when it traded into a 1-month flag pattern. Volume surged on the breakout and the high of the pattern was easily taken out. And in this case, it was the move to the midpoint of the pattern that accurately picked the level the upside energy would run dry. Here's Hanson Natural. The stock had steadily climbed for several months and then traded into a 4-month flag pattern. Volume surged on the breakout and the stock immediately separated itself from the pattern. In this case, it was the move to the far side of the pattern that identified an area profits should be taken. Here's FedEx. As is typical, the bull flag pattern was preceded by a steady rally. Then, after 3 weeks of consolidation, the stock busted out on a big surge in volume. The stock pulled back to test the breakout area after this. For a strong stock and in a steady uptrend, this is nothing to be concerned about. Stocks don't go straight up and they don't always do exactly what you want, when you want. In such a situation, have patience and let the pattern play out. Ultimately, it was the move from the previous breakout to the far side of the pattern that accurately picked the area the stock would run out of upside energy. Let's quickly go through a few more examples. We find it helpful to look at successful pattern formations to train our eyes. AutoZone. The stock gapped out of a bull flag on strong volume and rallied about 10 points to match the move into the pattern. ITRI, nice volume breakout. Merix, the stock rallied about 6 points into this flag pattern and then busted out on strong volume and rallied another 6 points. Ultratech, textbook breakout on huge volume. And Movie Gallery, huge volume surge on the breakout and the volume continued for several more weeks. That wraps up this tutorial. Again, bullish flag patterns are brief pauses within uptrends and should see a significant increase in volume upon breaking out. The extent of the advance will often depend on the overall market. A strong market will greatly help in achieving a more ambitious price target, but in a weak market, a trader should be happy with a moderate gain.